Bank of Canada has held its key interest rate as trade uncertainty persists, but Governor Tiff Macklem also opening the door for potential cuts. Andrew Kelvin, Managing Director, Head of Canadian Global Rate Strategy with TD Securities, joins us now with more. Andrew, great to have you back on the program.
Always a pleasure. Thank you for having me.
So the hold is not a big surprise. A bit of a crack open in the door is perhaps the need to have to cut rates. There are conditions, though. What's it going to take for the central bank to cut rates?
So the first thing I would sort of emphasize here is that, as you know, not a big surprise. The market was pricing in virtually no chance of a rate move here in neither direction. To the extent there was a bias in the market, it was slightly towards cuts. But again, nothing priced for this meeting, no forecast looking for a change. What the bank did do here was they maintained a little bit of I'd call it a dovish bias. It wasn't largely unchanged from June, though maybe a little bit more finely emphasized. What they've said is they are looking at essentially trying to balance the upside pressures from prices due to trade disruptions against the downward pressures on inflation due to weaker economic growth. And they do expect that growth was substantially slower in Q2 and will be on the sluggish side in Q3. They don't look for a full rebound. What they've said is that if growth weakens and inflation's contained, rate cuts may be necessary. They said that in June. But in June, they mentioned it in the press conference. In July, they mentioned it in the actual monetary policy statement.
Now we have it in black and white. That's a sound clip.
It was in black and white before, because they always release their statement for the press conference simultaneously, which creates a bit of a strange dynamic for people trying to read these things in real time, because I'll see headlines come up and I'll try and figure out, is it from the presser, is it from the communique? But our interpretation, I think this is a broadly shared interpretation, is that the things that are in the communique are more important than the things that are in the press conference opening statement. You know, to use a sporting analogy, it's like going from a AA team to a AAA team on some level. You're in the big time now. So I think that is the takeaway here, is that they maintain a cautious note around the economy. And I think that tells you sort of two things. One, they're trying to keep all options on the table here. They understand that it's still a very uncertain world that we're in. Governor Macklem did mention in the presser, in response to a question, I believe, that they still need to be a little bit less forward-looking than they normally would be able to be. That's why there are a bunch of different scenarios in their monetary policy report. The other takeaway, though, and I think this was, for me, the thing I was really interested going into this, is we'd had some pretty hot CPI prints. The persistence in inflation had been greater than perhaps we had anticipated, particularly once you strip out energy prices. And I was personally wondering if the BOC was maybe feeling a little bit alarmed by some of those CPI prints. I think what I would infer from what they said today is they're not overly alarmed by it.
Why would they not be overly alarmed? I mean, this is the mandate of the bank, right? To bring inflation to that sweet spot of about 2%. If core looks like it's a little hot, why aren't they more concerned?
So there's two pieces to that. One, they get a bit of a breather because of the elimination of the consumer carbon tax. Their target is headline inflation, not core inflation. So headline inflation is about 2%. So by the letter of the law, they are bang on their target here. So that's the first piece of it. The second piece of it is they mentioned prominently that they believe there's indications that excess supply in the economy has increased since January. To their way of thinking, the amount of slack in the economy or the amount of tightness in the economy is really what determines future inflation. So when they look at an economy that has seen excess supply grow, slack grow, which is something you've seen with the unemployment rate creeping higher over the course of the year. Just put that last unemployment report aside for a minute. Unemployment's been creeping higher. They see that as a sign that inflation is likely to remain under control through 2026, really. Come back down towards their target in terms of the core metrics. And ultimately, for that reason, they're not overly alarmed. I think the way I've tried to frame this is, based on what I read today, while they're balancing the risk, and they always should be balancing the risks, it seems to me that they see the risk associated with a weaker economy causing downward pressure on future inflation to be a bit more pressing than the risks of inflation being persistent at an underlying level that is above 2%.
If that's how the Bank of Canada is seeing the world, does that set us up for a September cut?
For a September cut to occur, and I should say up front, like our forecast is for rate cuts in September and October. For a September cut to occur, though, we do need that condition I mentioned earlier to be met. We need to see those signs of economic activity weakening come through in the next 8 weeks of data. We need to see indications in the next CPI report that we are seeing a little bit of moderation in underlying inflation. If those two things both come to pass, and particularly if the trading situation between Canada and the U.S. worsens, we could see rate cuts in September, absolutely. But it is highly, highly contingent on the data. That's a little bit of a, I think, a cheeky thing to say sometimes, that it's data dependent, because they're always data dependent. If things are really strong, they're not going to cut. That's how central banking works. But we are at sort of an inflection point in the economy, in their forecasting process, where if things weaken from here, rate cuts come back on the table. But if they hold it around the levels that recent data have perhaps indicated, I think it does make it a little bit more difficult.
You talked about the fact that they laid out 3 different scenarios, all based on tariffs and trade, as to what it could mean for the economy. From your point of view, and even sort of the view of your shop, is it sort of just hard to pick one right now? I mean, we're coming up, we're only days away from yet another deadline.
Yep.
Who knows what happens with that deadline? We're just days away.
So their central scenario assumed that whatever was in place on July 27th was locked in. They decided they would just take announcements as they came, which is, I think, a prudent approach. It means you no longer have to guess what other people are thinking. At least you can just work with the facts as they are. That was their central scenario. That had growth this year at about 1.3%, I believe, on an annual average basis, about 1.1 next year. That's not too far off what our forecast is. So I think as far as what that central scenario tells you, that's pretty reasonable. Obviously, we have this August 1 deadline coming up. The key thing for Canada, more so than the number that is applied to non-USMCA compliant exports, it's that ongoing USMCA exemption. That is by far the more important thing where Canada-US trade is concerned. And if that were to go away for whatever reason, that would spill the Canadian economy into a scenario that was substantially weaker. So that's sort of how we are thinking about that trading relationship.